As we have been reporting, home sales climbed from a record low in August, and the index of leading economic indicators, as Julie mentioned, also went up. But we're still not seeing more than what the Fed calls only modest expansion. Joining me now, LeBas, chief fixed income strategist at Janney Montgomery Scott. He's also one of the most accurate predictors of the economy based on data compiled by Bloomberg. We call him a Bloomberg best. Welcome back to Bloomberg News. Always good to have you on.
Thank you, Mark.
As Julie was just mentioning before we began the interview, index of leading economic indicators rising in August more than forecast. That does suggest the economy is going to keep expanding at least through early next year. But is that expansion going to be at a crawl?
Well, we are looking for a relatively slow pace of activity, and the real reason here is the consumer. Consumer balance sheets were absolutely decimated by the loss of home values, credit card defaults in the 2008 to 2009 timeframe, and the recovery process is going to take a lot longer than the crisis itself. So we're really looking for sort of anemic consumer activity to last well into the middle part of the next decade.
Is there anything that can be done to improve consumer spending before jobs return?
Realistically, not all that much. The forces that are really working their way through the U.S. economy right now, they're very large in nature. And that means there's no government program or sort of one-off action that can be taken to sort of push through those forces any faster than they're occurring naturally.
We have 7 of the 10 indicators in that leading index contributing to that gain in August. And as you're no doubt aware, that was led by the spread between the Fed funds rate and the 10-year Treasury yield, not to mention that increase we saw in the money supply. What is all of this data telling you?
Well, I think of the leading indicators, as we'd like to call them lately, the not-so-leading indicators, many of them are known well ahead of time. Within the leading indicators, there's a lot of points of sort of on the margin that indicate strong economic potential. But the key word here is potential. Many of these strong indicators, be they optimism in the manufacturing sector, be they a little expansion in the money supply, simply aren't translating to that core consumer spending that I referenced a few minutes ago. That's really the key here.
As far as bonds are concerned, you over at Janney, you are favoring investment in longer maturity debt. Is that going to be a bigger beneficiary than any quantitative easing too that we might see?
Sure. Well, of course, with the Federal Reserve out last Tuesday with a little bit of a hint that they will be considering quantitative easing in future months, there's been a pretty heavy action in the bond market subsequent to that. And we really feel that the longer the maturity, the better the bang for the buck as far as the QE program goes. So if the Fed does institute, it's going to be the 10-year and out portion of the yield curve that stands to benefit the most from that.
All right, LeBas, Janney Montgomery Scott joining us today. Always good to have you on. Thanks so much.